So, Chapter 17 is all about analyzing your financial statements and um, making decisions about them, because that's kind of the whole point of doing the financial statements, is to determine where your business is financially so that managers and owners can make decisions about where to go in the future of the business. And so, being able to analyze them is a really important part of accounting. And so, first of all, we need to look at some of the accounting ratios. And so, what they call vertical analysis ratios are going to be the measurement between the relationships between one financial statement and another. So, for example, when we do an income statement and we take our net income divided by sales and we get that percentage, that ratio, that is a vertical analysis ratio. It tells us how much of our net income came from our sales, basically. And so that's an example of that. And so on the income statement, the vertical analysis ratios are going to focus on how much ability the business has to basically earn a profit. And so a ratio that measures that ability to generate that income is what we call a profitability ratio. And so vertical analysis ratios on the income statement are examples of profitability ratios. So like the income statement, the net income to sales, like I talked about just a minute ago. And managers use these to make decisions. What are we going to do? Do we need to decrease expenses? Do we need to increase sales? What do we need to do with that? And for them to be effective, they have to set standards or what we call a benchmark, kind of like your benchmarks that you do in your classes when you take your benchmark um, exams that said this is where you're at, where do we need to go. That's kind of basically the same thing. It's a benchmark. This is where we are, or this is where you should be, and how does your business align to that. And a lot of times those benchmarks are set by an industry, depending on what industry your business is in. You can look at what are the industry standards and set your company's benchmarks accordingly to those standards. So some of the things that you have to take into consideration when you are determining your benchmarks. The first thing is the actual ratios from your prior fiscal periods. So a lot of times what a company is going to do is they're going to compare one year to another year to another year. And so they're going to look at current fiscal period ratios and look at prior years ratios and compare them. And then again, like I mentioned a minute ago, they're going to look at industry standards. What are the industry standards for this type of business? In the same industry, what do they do? Because you can look at those and go, okay, businesses that do the same thing I do have this ratio and they're able to make a profit and continue being a successful business. So industry standards are a really good one. They can look at the plan of the business plan, because when you set that business plan up at the beginning, that's how you kind of make decisions about how you're going to conduct your business. You do have to take into consideration some unexpected events. So there are things that are going to happen that might require you to revise your benchmarks. And it could be a natural disaster. A tornado comes through and destroys your business and you have to shut down. A pandemic happens and you have to shut down your business for a couple of months or something like that. So you have to take kind of those things into account too. And so like if you think about this year with the pandemic happening, businesses are going to be looking at those ratios, comparing 2020 to 2019, 2018, and they're going to know in their mind, well, 2020, this happened. And so those comparisons are going to look a little different. And so you have to take those things into account too. And they typically are going to set their benchmarks and then look at your ratios to see where they fall. Do they fall inside the benchmarks? Do they fall outside the benchmarks? And what are the causes of that? And what do we need to do to react to it? So in business, and this isn't on the slideshow, but in business classes, we talk a lot about SWOT analysis. SWOT analysis stands for strengths, weaknesses, opportunities, and threats. looking at these vertical analysis trends in your business are an example of something you would do in a SWOT analysis, looking at what's going on inside your business. So just kind of throw that in there for a minute. So when you're analyzing these trends with your vertical analysis, you're going to look at what they call comparative financial statements. Basically, it's going to be in this section, we're looking at income statements where you have multiple years of the data. And so on our income statements, we have a lot of stuff where you have multiple columns and you have where you do math and stuff. On a comparative financial statement, you're just going to have your totals so you can look at your main totals. And so we'll look at an example of that here in just a minute. So an analysis of changes over time is called a trend analysis. What is the trend? Are our sales going up? Or are our sales going down? And when you compare those financial ratios over 2 or more periods, you can find those unfavorable trends and the favorable trends. And the net income after federal income tax as a percentage of net sales is what we call profit margin. And so we look at what is our net income after we've paid our federal income tax. What is that amount compared to our net sales? That's our profit margin. And that is going to tell us basically how well we have made money, have made an income. So here's an example of a comparative income statement. And like I said a minute ago, you just have your totals here. Whereas on a regular, just 1 year income statement up here under cost of merchandise sold and gross profit, you would have all these other little columns and stuff, but these are just our totals so that we can do our percentages here, our ratios. All of these are this amount divided by your net sales, gives you your ratios here. These are all divided by our net sales because what this tells us on our income statement is we want to know how good we are at making an income. That income comes from the money coming into the business, which is our net sales. So in this example, we're going to look at this net income after federal income taxes. In the current year, that ratio is 12.7. Last year, it was 13.4. So if you look at that trend, our net income went down almost about 0.5%. Then I'm just going to pull out a couple of examples here. Utilities expense. Our utilities expense went up a little bit from 0.6 to 0.8. So that's an increase in utilities expense. Now, utilities is one of those that you may not have much control over. If the gas company or the utility company raises their rates, you may not have much control over how much that goes up, but that's a whole other thing. So are there any other ratios on here that you see that might be considered unfavorable? And as you kind of look through there, the miscellaneous expense went down. So that's not unfavorable. That's actually favorable. That's a good one. There really aren't any more that are going up really substantially. You have a little bit of an increase here, but the rest of them are all pretty well staying within that same standard. So to use your vertical analysis to look at gross profit. So for most retail businesses, which is what we're kind of talking about with this unit, cost of your merchandise is going to be the biggest cost the business has. That is the cost of what it takes for you to go out, buy the merchandise you're going to put into your business and sell to your customers. So controlling that cost is really, really important to maximize your gross profit, which means you really want to try to go out and find vendors that are going to give you good deals. They're going to give you discounts. They're going to give you, really good deals on merchandise that you can then turn around and sell for a good profit. So gross profit has to be large enough to cover your total operating expenses and give you the net income that you want. And so the vertical analysis ratio for the cost of merchandise sold and gross profit are similar. Both of those ratios focus on the relationship between sales and the cost of merchandise sold. So the cost of merchandise sold and the gross profit. So let's go back and look at this. Cost of merchandise sold, this ratio is taking your cost of merchandise sold divided by net sales, and then your gross profit is taking this one divided by net sales. And they're both up there in the same area. And any increase in the cost of merchandise sold is going to reduce that gross profit. So on our visual here, if this number, if you take your net sales minus your cost of merchandise sold, gives you gross profit. If your cost of merchandise sold goes up, of course your gross profit's going to go down. That just makes sense. But it's easier to see it, I think, here in a visual than it is to just read it in those words on the next page. So gross profit as a percentage of net sales is what we call gross margin. So this is just that, what I was showing you on that last slide here. So this same thing here. So this ratio is also referred to as gross profit margin. So what is the trend for our gross profit margin? You're going to look at this, and this year is 58.8. Last year it was 60.9. So the trend is that it is going down a little bit. Now, if this was my business, I would maybe even want to go back another year to a previous year and see what it was that year, and then look and see what we're going to see, if this is really a trend or if there is something else going on that's caused that to go down a little bit. So when you have an unfavorable gross margin, you have basically two options or actions that you can take to correct it. The first one is increase your unit sales prices. And which means that if you're currently selling something for $4, you can raise the price to $6 or whatever. The problem with increasing prices is that you want to make sure you do not price yourself out of the market, meaning that if you increase your prices too much, customers will go to a competitor, or they'll just quit buying your product altogether if it's not a necessity. So you really got to be careful about increasing unit prices and making sure you do not lose customers when you do increase your prices. And the second option is to decrease the unit cost of merchandise. So when you decrease the unit cost of merchandise, you will increase the gross margin. And to do that, you basically have to look at your purchasing practices and see if you can find a way to decrease those costs. Can you buy in bulk and therefore get them at a lower price per unit? Can you find a different vendor that has a lower cost? The thing about buying in bulk is that works if it's stuff that isn't going to go bad. If you're a clothing store, you also have to look at buying in bulk, because are you going to buy too much and not be able to sell it, and then you're going to have to put it on clearance at the end of the season, and that's going to cause issues there too. So as you do this, you really got to look at all of the things that go into what is the nature of your business and the merchandise that you're purchasing, and can you buy in bulk like that, or are there other vendors out there with lower costs? A lot of times businesses will try to do a combination of the two. Let's try to maybe increase our prices just a little bit so that we don't lose customers. So in this example up here, it says the markup of an item purchased for $4 and sold for $10 is $6. So if they're selling it for $6, maybe instead of bumping that price up to $8, they bump it up to $6.75 or $7 or $6.50. And so depending on how much you're selling, how many units you're selling, you're still making a little bit more, and maybe we can lower our costs a little bit. So doing a combination of the two is a lot of times a really good option. So the income from operations as a percentage of your net sales is what we call operating margin. And it basically tells us what our return on our investment is, or our return on sales. And it gives us our best indication of how the business is earning a profit from its normal business operations. Basically that revenue coming in. And so when you look at the total operating expenses as a percent of net sales is operating expenses ratio. So when you look at this, all of your expenses added together divided by your net sales gives you your ratio for your operating expenses, and then also your income. So income from operations is going to be, I'm going to go back. I want you to see the full thing here. So you have your gross profit minus your total expenses gives you your income from operations. So that's what we're looking at with this little bit here. But sometimes it's helpful to see that full thing. So your income from operations and your total operating expenses. So that's what those ratios are looking at. So if you want to correct an unfavorable expenses ratio, you can reduce the operating expenses. Basically, you're going to look at what are the expenses that are higher than expected and what can you do to reduce them. You can modify the benchmark because, as I mentioned a little bit ago, sometimes some of those expenses are beyond your control. If the electric company raises their rates, even if you try to conserve your energy and turn more lights off or lower your heat or lower your air conditioner or do whatever, your rate might still be higher. And so that's something you really don't have much control over. So you might have to modify that benchmark a little bit. You could attempt to increase those net sales. And again, this can only be done if the number of items it sells, or to increase the number of items you sell, or increase the price of each of those items, like I talked about on the last sale or on the last slide. So you've got some options there. And again, reducing expenses and increasing sales, a little bit of a combination a lot of times is a good option. One thing to keep in mind is that sometimes expenses fall short of a target range, meaning that you have a target range and your expenses are below what you think they're going to be. Normally, most people would go, oh, that's good because my expenses are really low and I don't have to worry about them. But you got to really look at that because those can cause some issues too. So for example, you decide you need to cut costs. So instead of having 4 employees, 4 salespeople on the floor during really busy time, you're only going to have 2. So you cut back your employees' hours. That can cause issues with they may go look for another job and you're going to lose good employees because they're not getting the hours that they were getting before. B, your customers are standing in line longer and they're getting upset because they're not getting as good a customer service. So you lose customers. So that could be an issue. You got to really look at that. Maybe you decide to reduce advertising expenses. And so you don't advertise as much and you start losing customers to competitors because they don't know about you, or they need to be reminded that you're there. And so you could lose customers because you've reduced that. And then another example would be if a company wants to reduce their depreciation expenses, and so they don't replace an old computer system and their customers aren't as productive because of that. So when you start looking at expenses, you not only want to look at the ones that are too high, you might also want to look at the ones that are too low. And are there some things you could do to help make your business more productive, which in turn would increase your sales? And so there's a combination of things and a lot of things that got to be looked at as far as analyzing those financial statements and making those decisions as they go through them.